Good day, everyone. This is the third part of our discussions involving consolidated statement of financial position at the date of acquisition. Remember, in the second session, we've discussed about what would be the consolidation procedures in case that a certain company that is the parent or acquirer acquires a subsidiary with less than 100% of its shareholdings. Therefore, there is an NCI. So that's discussed exhaustively in the second part as well as the supplementary two series or parts of videos. And for now, we are going to tackle or discuss the continuation, so techniques as to the value analysis, then what will be the treatment of subsidiaries pre-existing goodwill. Then also we are going to tackle about the fair value adjustments just in case that there will be a business combination achieved in stages and push down accounting. So let's go. I'll proceed. Now, here are the techniques again in the calculation and allocation of goodwill and or gain on acquisition. Actually, this has been also discussed in part 2, but we'll just be going over such again. This is the value analysis schedule. As said, for step 1, we just have to enter the values found or given in the problem. Then make use of the appropriate percentages. Then normally, these amounts are fixed regardless of the price paid by the parent. So this is true because the fair value of net assets excluding goodwill would be always what it is, then 80% and so on. And this is again the minimum, 124,000. Then we are going to enter the price paid by the parent here. Although if we are getting used to this, we can just fill out whatever info that we can place anywhere or anyhow for as long as it is on the appropriate column and the values are correct. So step 2 is here, parent price. Step 3 is we are going to place the NCI value, which is at 180,000, for example. So this must be, oh, it's not stated here. This could be given. So a given NCI value then, for example. And so there's a note here though that if we use the proportionate value of 150,000, which is actually the proportionate value here that is meant is the fair value which is estimated. So under the full goodwill method or approach. In fact, you can see here this is crossed up 600,000 divided by 80% times 20% is 150,000. So this is the fair value of NCI estimated. This is given and this is the minimum, which is the proportionate share of identifiable net assets of subsidiary. Anyhow, 150,000 is still greater than the minimum. So granting that this is really 180,000 as given, so we just have to add this one and we will get the goodwill, 160,000. Then we can simply say that a portion of the goodwill belongs to the parent and also with the NCI. All right. So hopefully that is clear here for this particular situation. Okay. So what about if there is a gain on acquisition? So in this case, again, follow the steps. Simply fill out the table, which is again the value analysis schedule or table, or let's just say a tabular presentation. So value analysis presentation. So place here 450,000. Then, oh, so probably this is the minimum as said. There's no mention as to what should be placed here. Is it like a given NCI or whatnot? So probably in this case, supposedly we are going to cross up, remember, if this is silent, but I suppose because they chose the usage of the minimum, so in this case, this is like really to use option 2. So with the use of option 2, we can notice that the NCI share of gain on acquisition is 0 and the entire gain on acquisition belongs to the parent. then take note that C1 cannot be less than C2. Again, this is the minimum. So the NCI value then is equal to that. All right, so what if it is 130,000 pesos NCI fair value? This is above 124,000. So if we do the math here, the calculations, we are now going to deduct, of course, so we can actually see here that the company fair value is the sum of the parent price plus NCI, just to have a review though. And then that's why if we are going to add 450 and 130 in thousands, such would equate to 580,000 pesos. And then for number two, the fair value of net assets excluding goodwill, that's going to be the sum here of the two also equals 620,000. So I hope that is clear. Although again, that's already said, but just to emphasize that again. Then we deduct here, so this is 40,000 negative, also deduct and deduct here. So we can just notice that with the 40,000 gain on acquisition overall for the company, 46,000 belongs to the parent, while the 6,000 belongs to the NCI. And to eliminate this, we are going to debit investment in S company for 46,000, and then NCI has to be given 6,000, and the retained earnings for the company should be gain on acquisition of 40,000. And by the way, this elimination entry is just to illustrate as to the impact of the gain on acquisition in this case. Because if this is like the real elimination, remember, elimination entry number one would deal with the elimination of the equity accounts of the subsidiary at values. Then we are going to credit the investment account for the subsidiary and the NCI. While the second entry would deal with the recognition of excesses of fair value over book value, and also recognition of any goodwill or gain on acquisition. If gain on acquisition, it will be a credit to the retained earnings of the parent company. Then also with the investment accounts remaining. So in this case, the investment in S company would have a different value. So DNA of excess schedule would be very helpful here to be able to know how much really should be the amount of the investment and NCI allocation then, so that we will see the overall impact. All right. So I hope that is clear for the techniques and valuations using the value analysis schedule. Now, another one is when there is a subsidiary's pre-existing goodwill, meaning to say when we acquired a subsidiary as a parent, there's already an existing goodwill. So remember, we said that in acquisition, we only have to recognize all assets which are identifiable, even the unrecognized, for as long as they are identifiable. Because goodwill is an unidentifiable intangible asset, because for it to be able to exist, we must acquire a business. So meaning it is not separable from the business. For an intangible asset to be separable, it must be that it can be separated, it can be sold, it can be entered into transaction, leased, transferred, bartered, exchanged without affecting the business as a whole. So, or without ending the business. So that's why goodwill is not included in the fair value of the assets, as well as the identifiable net assets computations later on, assets minus liabilities assumed for the purposes of computing the goodwill. All right. So the goodwill or that goodwill is ignored in the computation and allocation of excess. So here is an example. 80% in case 4, same illustration. Goodwill of 50,000 that is already existing, and the retained earnings balance is 170,000. So if you can notice, for the purposes of computing the fair value, goodwill is reduced to 0. So that's how it is. Then the net assets is 620,000. So to record the transactions, if you can notice, the fair value of NCI is assessed to be at 200,000. So this is like a given NCI, and we are going to check if it satisfies the minimum. The minimum is 620,000 times 20%, it's 124,000. So clearly, I think we are able now to memorize how much really is the value of the minimum non-controlling interest. So same entry actually in the previous examples, expense immediately for the professional fees. This is the value analysis schedule wherein we can see that we have, so same goodwill, 380,000 in the introduction for case 4 because this 200,000 is given in the case here, but it is like also the full goodwill approach. That's why it's familiar as a value. Then another important thing or consideration is that the goodwill again is having a share of 24,000 to the parent and NCI 76,000. So this is again the value of analysis schedule. We have to know the meaning or the format or the term used, for example, of the schedule, because it's possible that it will be asked in the problem. Compute the goodwill or gain on acquisition using the standard formula, using the value analysis schedule, using the DNA of excess schedule. So that's why we have to know the terms. Then this is for the DNA of excess schedule, in which we have again the format, then fair value less the book values equals the book value that actually has been here. So this is actually to be moved supposedly at this part here. This is like an error of spacing. So try to 70,000 times 80%, that's 296,000. Move this here and 74,000 here. Okay, so that's why I was like looking at the illustration. Anyhow, so 1 million fair value less the book value of interest acquired equals the excess of fair value over book value of the subsidiary as a whole at 630,000. And again, this illustration is very useful and helpful for the sake of consolidation purposes because these values that I am pointing out will be utilized in the elimination entries. Then here are the excesses of fair values over book values of the assets at 300,000 negative. And as what I've said, if we would like to have direct computation, we can just do the opposite. Instead of negative, this is to be added here, 270,000. So that's going to be 670,000. 1 million minus 670,000 equals 330,000, which is the goodwill then. All right, so for the elimination entries, again, first elimination entry is to eliminate the book values of the equity accounts of the subsidiary, then crediting investment and NCI respectively, the controlling interest though for the investment in S company. Here they are, the values. Next would be note 504,000 and 126,000 here. And we debited the excesses of fair values over book values, then the goodwill as it is 330,000. If you can notice, there is here an info 380,000 supposedly. If ever, for example, we have recognized the goodwill, but then we did not. So that's why it is reduced to 330,000 pesos. Next is push down accounting. This will be the last topic. For push down accounting, this is like the consolidation that we do, except that we are going to make use of additional paid in capital as an absorbing figure. So if you can notice here in the entry, we updated the assets. If there are any liabilities, also update. By the way, liabilities assumed from book value or book values to fair value or fair values. Then we are going to recognize the retained earnings for S company account. Now you might be wondering as to where is this retained earnings S company account coming from. So this is at 120,000. Actually, this is the given retained earnings of S company. Anyhow, before I go back to page 150 of case 4, because we have to confirm the values though. So allow me to mention to you the procedures. So under push-down accounting, the allocation is recorded in the books of the subsidiary by means of adjusting entries, thereby affecting its separate financial statements. If it's not a push-down accounting, remember the things that we've discussed a while ago for consolidation, we have to take note that the adjustments of identifiable assets and liabilities will have to be placed only as part of the elimination entries for the purpose of consolidation. But if we are using push down, so we have to reflect that under the subsidiaries financial statement separate. So meaning the books of accounts of the subsidiary then would be adjusted so that the values will be reflective of the fair values. Then the adjustments of identifiable assets and liabilities of the acquired subsidiary and the recognition of goodwill are accompanied by a write-off of the subsidiary's retained earnings. So this is what I meant, that the retained earnings 120,000 here is given in the problem. And then we get the total of all adjustments for the assets, the goodwill, and then the retained earnings as eliminated, and the total will be the additional paid in capital. All right, so that's how we got the values then. Then allow me to go back to the page 150. All right, so here is the page. Then we can notice here retained earnings at 120,000, and this is that account that we are going to eliminate. Then also we can see that here the book value of retained earnings as eliminated. The excesses are here of fair value over book value, which will be recognized. And then the total again will be credited to additional paid in capital. So let's go back to that part. So what is the point now under push-down accounting? It actually simplifies the consolidation process because we are already done with the adjustments of book values to become reflective of, again, the fair values in the separate financial statements and records of the subsidiary. So no need to do that in the consolidation. Then push-down accounting revalues subsidiary accounts directly on the books of the subsidiary based on the adjustments shown in the D&A of excess schedule. Very true. This part here shows that. Then in the elimination entries though, so this is just how simplified it is. No elimination entry number 2 anymore. Just E1, eliminating the book values of interest acquired of S company. If you can notice, just the common stock and the UPIC, because the retained earnings has already been absorbed already. And then what else? We have the investment, 800,000, which is already the cost, and this is the given NCI at fair value, 170,000 pesos. And finally, to formally end this additional paid in capital, 180,000 is given in the problem. This 770,000 is from here because the retained earnings has been eliminated already. All right. So hopefully you've learned something from this session, part 3, and watch out for part 4 for consolidated statement of financial position, date of acquisition. Hopefully you've learned something from this session. Thank you and God bless us all.